The illusion of stability to most Americans, the U.S. banking system appears stable. Banks remain open, deposits seem secure, and financial markets continue to operate normally. But history shows that banking crises do not begin with panic. They begin with quiet warning signs. Fragility builds beneath the surface long before headlines acknowledge it. The aftershock of 2023 was never resolved. The regional bank failures of 2023 were publicly described as isolated mistakes. Officials labeled them idiosyncratic, suggesting system-wide safety. Yet regulators themselves acknowledged that emergency measures, not structural fixes, prevented broader collapse. The problems were paused, not solved. Source: Federal Reserve FDIC statements. Unrealized losses still haunt bank balance sheets. According to FDIC and Federal Reserve data, U.S. banks are holding over $500 to $700 billion in unrealized losses on securities, mainly U.S. Treasuries and mortgage-backed bonds purchased during the zero-rate era. These losses are hidden on balance sheets only because the assets haven't been sold. Source: FDIC Quarterly Banking Profile, Federal Reserve H.8. Why unrealized does not mean safe. If deposit withdrawals accelerate, banks may be forced to sell these securities at steep losses. At that moment, accounting losses instantly become capital losses. This is exactly what triggered previous bank collapses, not bad loans, but forced liquidation under pressure. High interest rates created a structural trap. For over a decade, banks structured their business models around near-zero interest rates. When the Federal Reserve raised rates rapidly, asset values fell while deposit costs rose. This reversed decades of stability assumptions baked into risk models, stress tests, and regulatory frameworks. Deposit flight is already visible in the data. Federal Reserve and Fed data show hundreds of billions of dollars leaving regional banks, flowing instead into large institutions and money market funds. Depositors didn't panic. They followed yield and perceived safety. Source: Federal Reserve Bank of St. Louis. Fred, money market funds signal stress U.S. money market funds now exceed $6.5 trillion in assets, the highest level in history. These funds surged precisely when banking stress peaked, acting as an alternative to traditional bank deposits. Source: Investment Company Institute. Liquidity is becoming the core threat. Modern banks fail not because they lack assets, but because they lack immediate liquidity. Digital banking allows billions to exit a bank within hours. Confidence, not capital, is now the true foundation of banking stability. Commercial real estate is the silent time bomb. Roughly 70% of South commercial real estate loans are held by small and mid-sized banks. Office vacancy rates in major cities now exceed 18 to 20%, driven by remote work and economic slowdown. Source: Federal Reserve, Moody's Analytics, MBA. Refinancing risk peaks between 2024 to 2027. A massive wave of commercial real estate loans is set to mature over the next few years. Many properties cannot refinance at today's higher rates. Loss recognition is becoming unavoidable. Emergency lifelines are masking fragility. The Federal Reserve's emergency tools, including the Bank Term Funding Program and increased discount window borrowing, stabilized markets, but they also revealed dependency. Banks borrow from these facilities only when private funding tightens. Source: Federal Reserve Balance Sheet Reports. FDIC insurance is limited by design. Total U.S. bank deposits exceed $17 trillion, while the FDIC insurance fund holds roughly $120 to $130 billion. The system works only if confidence holds. Broad panic would require government intervention beyond FDIC resources. Source: FDIC Annual Reports. Too big to fail is bigger than ever. Bank consolidation has accelerated. Since the 1980s, more than 4,000 U.S. banks have disappeared, while deposits increasingly concentrate in megabanks. Source: FDIC Historical Banking Data. Concentration creates a new type of risk. Fewer banks now hold more deposits. This appears safe until one large institution experiences stress. Larger failures are harder to contain, raising systemic risk despite regulatory oversight. Lending standards are tightening nationwide. The Federal Reserve's Senior Loan Officer Opinion Survey shows banks tightening credit across mortgages, business loans, and consumer lending. This reduces economic growth and signals caution inside the system. Source: Federal Reserve SLOS. Loan quality is quietly deteriorating. Credit card, auto loan, and small business delinquencies are rising. These increases remain modest for now, but history shows defaults rise slowly, then suddenly. Source: Federal Reserve. New York Fed Household Debt Report. Profitability is under pressure. Net interest margins are compressing as funding costs rise faster than loan yields. At the same time, banks must increase provisions for potential credit losses. Source: FDIC Quarterly Banking Profile. The shadow banking system adds hidden risk. Private credit funds, hedge funds, and non-bank lenders operate with less oversight, yet they remain deeply interconnected with traditional banks. Stress in shadow banking can spill over rapidly. The Federal Reserve is policy-trapped, keeping rates high fights inflation but stresses banks. Cutting rates too fast risks reigniting inflation and asset bubbles. This limits the Fed's ability to respond aggressively to banking stress. Digital banking accelerates contagion. A modern bank run no longer takes days. It takes minutes. Social media amplifies fear, rumors spread instantly, and deposits move at digital speed. Regulators are fighting the last crisis. Many safeguards were built for slow-moving crises. Today's risks are fast, digital, and systemic. Policy tools lag behind modern financial realities. Politics complicates crisis response. Public resistance to bailouts limits policy flexibility. Political polarization slows decisive action, increasing risk during moments of stress. Banking stress often precedes recessions historically. Tightening credit and banking instability lead economic downturns. Lending slows, hiring weakens, and investment dries up. The greatest risk is contagion, not collapse. No system breaks because of one failure. It breaks when confidence spreads from one institution to another. These aren't theories or predictions. Every number comes directly from the Federal Reserve, the FDIC, and U.S. regulators themselves. 1. Unrealized losses on bank balance sheets. U.S. banks are sitting on over $500 to $700 billion in unrealized losses on securities. These losses come mainly from treasuries and mortgage-backed securities purchased when rates were near zero. Official sources: FDIC Quarterly Banking Profile. Why this matters? 2. Deposit flight from regional banks. Hard data in 2023 to 2024. Regional and community banks lost hundreds of billions of dollars in deposits. Large banks and money market funds absorbed most of that money. Official sources: Federal Reserve Bank of St. Louis, Fred, Investment Company Institute, money market fund data. Key fact to say: in video depositors didn't lose confidence in banks. They moved their money to where yields were higher and perceived risk was lower. 3. Money market funds hit record highs. U.S. money market fund assets exceeded $6.5 trillion, the highest level in history. This growth accelerated after bank stress events. Official source: money leaving banks reduces liquidity and raises funding costs, weakening lending capacity. 4. Commercial real estate exposure is concentrated. Hard data is almost equal to office vacancy rates in major cities exceed 18 to 20% in some markets. Official sources: critical point. 5. Rising bank borrowing from the Fed. Hard data: banks made heavy use of emergency facilities such as Bank Term Funding Program, BTFP. Discount window borrowing spiked after banking stress and remained elevated. Official source: Federal Reserve Weekly Balance Sheet Reports, meaning banks only use emergency liquidity when private funding becomes difficult or expensive. 6. FDIC insurance is structurally limited. Hard data: total U.S. bank deposits, $17 trillion. FDIC Deposit Insurance Fund, $120-130 billion. Official source: the FDIC system works only if confidence holds. It cannot fully insure the entire system during widespread panic. 7. Bank lending standards are tightening. Hard data: the Fed's Senior Loan Officer Opinion Survey shows reduced willingness to lend. Tighter credit standards across consumer, business, and real estate loans. Official source: 8. Rising loan delinquencies. Credit card and auto loan delinquencies are rising toward pre-2008 levels. Small business defaults are increasing as borrowing costs rise. Official sources: Federal Reserve New York Fed Household Debt Report. 9. Banking profitability is declining. Hard data net interest margins are compressing. Higher funding costs plus rising loan losses equals weaker earnings. Official source FDIC Quarterly Banking Profile 10. Bank consolidation is accelerating. Hard data, more than 4,000 U.S. banks disappeared since the 1980s. Deposit concentration at top institutions continues rising. Official source FDIC Historical banking data risk. Bigger banks equals bigger failures if something goes wrong. Final warning: the U.S. banking system is not collapsing today, but it is cracking. Every warning sign is visible in official data from the Federal Reserve, FDIC, and U.S. regulators themselves. Unrealized losses, deposit flight, commercial real estate exposure, liquidity dependence, policy constraints. These are not theories. They are facts. Closing line banking crises don't begin with failure. They begin with denial.